January 1, 2018. Real Estate Capital Scoreboard January 2018. Chicago, Illinois, January 1, 2018. Investors welcome 2018 with tempered economic expansion, favorable demographic trends, and comparatively low interest rates. Many expect commercial real estate values to soften, but few expect reversals. Incredible growth over the past couple of years create fears of market corrections. Investing emphasis continues to focus on prudent property sector plays as follows. The unstoppable sector. Investment and development opportunities runs unabated for industrial and distribution properties, as supply chain management serves rapidly expanding e-commerce needs. This sector remains one of the few development opportunities fueled by spec construction. The peaking sector? Multifamily property development may have reached the highest prices, but investment fundamentals are still solid. The most direct housing competitor, for sale homes/condos, are extremely supply constrained, forcing many potential homeowners to continue renting. Moreover, renters will be tempted by some upcoming bargains this year, as many markets are temporarily plagued by an oversupply of new construction inventory. In the long run, development niches can be found by serving pent-up demand due to migration and growing population/employment bases in Sunbelt areas. The recovering sector? Except for the highest quality centers, prices flirt with record low levels. Surviving centers well positioned within infill locations are supplementing successful brick-and-mortar retailers with entertainment and food services components. Additionally, more customer services such as free pickups and returns of online orders and layaways help drive more store visits. Rent will remain flat or rise modestly as owners seek to replace failing retailers with fresh tenants. Look for percentage rent clauses to diminish, as new leases will rely more upon base rents due to internet sales accounting issues. The caution sectors. Office and lodging properties are on investors' watch lists. Office properties serving pedestrian and transit-friendly locations should bode well. Office uses thoughtfully integrated within mixed-use projects will survive as well. Only bargain pricing will drive car-centric, suburban deals. After nearly a decade of sustained growth, the lodging industry may slow down. Occupancy rates remain high, but are threatened by Airbnb, less foreign travel, and new construction. The Real Estate Capital Institute's director, John Oharenko, notes, capital markets absorbed a lot of upbeat news translating to record-breaking stock market behavior. After tax reform, absorbing the upcoming Fed rate hikes, everyone is waiting for what's next?
February 1, 2018 Real Estate Capital Scoreboard February 2018. Chicago, Illinois, February 1, 2018. Benchmark rates hit a three-year high this week, as investors track Fed monetary moves in the face of new government spending needs and worldwide economic growth. Following this trend line, mortgage rates are on the rise, although not at full parity. Property owners can expect to see the following underwriting trends over the coming months. Active rate management. Low rates are no longer taken for granted, and simply capturing cheap debt is becoming more difficult. With short and long-term rates rising, hedging and other interest rate protection strategies are resurfacing. Moreover, creative lenders offer options such as float-to-fixed loans, or vice versa, for greater optionality, if borrowers feel compelled to lock into fixed rates due to increased pricing concerns, or alternatively need to reorganize loans to avoid incurring prepayment penalties associated with fixed-rate debt, usually necessary, if an asset sale is planned in the near future. Tighter spreads, the trade-off of lower rates for lower leverage benefits borrowers targeting the best pricing. Even as benchmark rates climbed over 30 basis points within the month, lenders absorbed spreads to keep loan production fluid. Mortgage rates are only 5 to 15 basis points higher, as a net result. Debt service coverage, lower leverage loans are the norm in comparison to historical levels. As prices rise for premier properties, borrowers are forced to accept less proceeds since debt service coverage supersedes loan-to-value limits as a key underwriting variable in these cases. High prices directly translate to higher equity contributions, in exchange for favorable debt terms. For best pricing, 65% LTV or less are commonplace, often based upon 1.40x or more debt service coverage. Mr. John Oharenko, director of the Real Estate Capital Institute, advises, borrowers are definitely paying attention to higher rates, after enjoying extremely low rates for several years. As rates gradually rise, sellers and buyers will realign their expectations, but at a slower, wait-and-see pace.
March 1, 2018. Real Estate Capital Scoreboard - March 2018. Chicago, Illinois, March 1, 2018. With rising rates in the forefront of headline news, underwriting percent figures re-emerge as hot discussion topics as the 10-year Treasury note hit a 4-year high earlier last month. Noteworthy percent benchmarks include 2% to 3%. As the U.S. economy enjoys 7 years of prosperity, recessionary fears are nowhere in the foreseeable future. Record low unemployment not seen in more than 15 years, accompanied by strong consumer spending and controlled inflation, about 2%, assures favorable economic conditions in the foreseeable future. The Fed's new chairperson will make fighting inflation a top priority, so rising benchmark and mortgage rates are in store with the 3% plus level to reappear for 10-year treasuries. European and Asian markets are also strong, with economists expecting over 3% growth worldwide. 4% to 5%, mid-single-digit rates are back in the spotlight for longer-term, permanent debt. While lower 4% handle rates are still available for more conservatively funded loans, 5% rates are appearing more often, usually for higher loan proceeds, not regularly seen since 2011. 25%, energy conservation measures can really be profitable, not only because of lower expenses, but because of lower rates. 25% energy or water bill savings equate to agency multifamily pricing discounts that can also be 0.25% or more. 125% negation as mortgage rates climb, and capitalization rates remain low. Debt service coverages of 125% or more drive loan proceeds. Loan-to-value ratios are important, but lenders demand cash flow coverage to drive deals within stated underwriting objectives. However, record low capitalization rates should continue to benefit sellers, as buyers are still highly motivated to purchase quality realty assets due to limited supplies in prime locations. 150% or more debt coverage attracts the best pricing, especially with life companies. On the flip side, long-term, self-amortizing loans backed by credit income approach coverage closer to break-even levels. The Real Estate Capital Institute's director, John Oharenko, comments, percent figures are always important parameters to watch in realty finance. It's a numbers game that quickly quantifies lender and borrower risks/reward expectations.
April 1, 2018 Real Estate Capital Scoreboard - April, 2018. Chicago, Illinois, April 2, 2018. Last month's Fed rate hike was a result of a stable and strong economy characterized by tight labor markets. As short-term rates climb, long-term rates stay stubbornly low. Today's prime rate, 4.75%, is often more costly than typical 10-year mortgages. As a result, borrowers are rewarded with better pricing for securing long debt instead of riding with floating rates. After adjusting for compressed mortgage spreads and Treasury rate hikes, mortgage rates are about the same as January of last year. Given these inverted-term mortgage market conditions, the following observations are noted. Volatility. Even as the Fed is expected to raise rates throughout the year, global events dominate pricing beyond monetary policy control. March's 5- and 10-year Treasury movements in excess of 15 basis points prove that less predictable rate behavior is now normal. Also, the same two Treasury notes are only 18 basis points apart, historically out of balance. Tight spreads. Even as conduit pricing widened over recent weeks, nearly 20 basis points during the past quarter, relentless competition from other sources and lack of product keep loan spreads from widening too much. Mortgages still provide attractive pricing as compared to equivalent corporate bond yields. Creativity: above and beyond pricing, lenders now generously offer interest-only payments as part of the underwriting. Expect to see even more freebies, or at substantially reduced costs, such as appraisals and third-party fees incorporated into the loan closings. Bridge lending programs prove to be popular forms of creative financing for value-add properties with about 100 funding sources targeting such opportunities. Variety: a multitude of lenders target different components of the capital stack, offering many attractive funding choices. Banks stay on the short end of the term curve, life companies and conduits battle for longer-term debt, agencies target all types of multifamily opportunities, and debt funds provide higher proceeds. With so many sources, pricing consistency varies as lenders continuously adjust offerings. Advertised pricing and terms will often improve, at times dramatically, due to intense competition. The Real Estate Capital Institute's John Oharenko recommends, loan underwriting is evolving quickly as lenders juggle with finding winning funding formulas. Commercial real estate is still a darling sector for investment managers.
May 1, 2018 Real Estate Capital Scoreboard-May, 2018. Chicago, Illinois, May 1, 2018, last witnessed 4 years ago, the 3% benchmark treasury is the biggest news this spring. Lenders and borrowers alike are adjusting yield requirements, as the Fed expects at least a couple of rate hikes to stay within the goal of managing inflation in light of a strong economy. Since pricing is still very competitive even at higher levels, other trends take center stage, including too much money chasing too few goods. A large variety of lenders leave little elbow room for profitable returns. For instance, debt fund pricing terms now comparable to major banks' offerings last year, with mortgage spreads compressing 200 basis points or more. Lenders pick their spots with smaller banks locally capturing borrowers by offering flexibility and leverage. Life companies, banks and conduits are promoting more one-stop capital stack solutions, including pairing mezzanine financing with conventional senior debt. Agencies overwhelmingly dominate multifamily lending with higher leverage loans featuring favorable pricing and supplemental financing optionality. It's a downward race to the yield bottom. Blurred investment strategies, core plus, value add and opportunistic investments are more difficult to segregate. Fund managers struggle with tightened returns between various classes, as overall returns narrowed by at least 300 basis points on the higher end of the risk spectrum. Some of the highest yielding deals are now priced in the mid-teen yield range. Meanwhile, core and core plus yields trade in the middle to higher single-digit range, with minimal room to move downward. New construction deals in demand. Since existing institutional quality assets provide minimal returns, investors seek new construction opportunities, especially for projects underway. Rising construction costs restrict more development supply. Even as new construction cranes crowd urban skylines with apartment buildings, concerns are muted as jobs follow talent to center business districts at a record pace. Also, spec industrial properties briskly sell, often at prices reflecting 20% or more premiums over replacement costs. Mr. John Oharenko, the Real Estate Capital Institute's director, suggests, the party is over for extremely low borrowing costs. However, permanent, long-term, rates priced comfortably below 6% are still a historical bargain this generation. June 1, 2018 Real Estate Capital Scoreboard-June, 2018. Chicago, Illinois, June 1, 2018. From the middle of last month, benchmark rates peaked to their highest levels since 2014. The 10-year Treasury topped 3.05% and settled down by 15 basis points by month's end. The markets are bracing for as many as 3 more Fed rate hikes this year. Policymakers target a 2% growth rate, helping to create, and prolong, the following trends. Higher rates and spreads. Unlike earlier this year when funding sources often absorbed rate hikes with tighter mortgage spreads, pricing is widening. Overall rates are about 30 basis points higher than a month ago. Furthermore, higher leverage loans, for example, 85%, substantially widened by about 1%. Today's rates are in the mid 4 to 5% range for permanent debt of 10 years or longer for lower leverage loans. Higher leverage pricing starts with a 5% handle. Real property is real safe. Even with rising rates, investors want solid and safe yield alternatives to stocks. For the most part, commercial real estate supply-demand basics appear balanced. Fundamentals remain solid across property types, with some concern of overbuilding in select multifamily markets. Credit-tenant properties attract the most demand, followed by industrials, apartments, retail and office ventures. Prime senior, student, self-storage, data center and lodging assets attract competitive pricing that closely competes with traditional property types. More and more, investors are turning their attention to infill and transit-oriented locations, moving away from focusing on separate asset classes, with mixed-use properties emerging as favored investments. Mission money. Social investing gains momentum as financial institutions and governmental agencies tackle a myriad of real estate issues. Investors and developers work with municipalities to solve workforce housing demands by negotiating favorable zoning, property tax relief, etc. Meanwhile, attractive financing surfaces through availability of construction loans, as well as higher leverage and lower interest rates. In exchange for favorable long-term debt, owners frequently agree to maintain lower rents in conjunction with a debt term. The Real Estate Capital Institute's director, John Oharenko, notes, creating a perfect deal from the financing perspective would be focused on an urban, infill mixed-use project with a balanced affordable rental component. July 1, 2018. Real Estate Capital Scoreboard July 2018. Chicago, Illinois, July 1, 2018. Even as the Fed increased rates by a quarter point last month, benchmark 5 and 10-year treasuries held steady. Experts have been predicting narrowing spreads and rising indices for quite some time. For short-term, floating rate debt, such logic holds true, but long-term rate behavior has baffled even the most astute pundits. Investors continue seeking treasuries as financial protection against global turbulence, keeping long-term debt borrowing costs low. Patience is paying off for borrowers waiting to lock into favorable fixed rates, even in the face of more rate hike threats. Mortgage pricing barely changed as compared to the previous month. Spreads narrowed by about 5 basis points from last month. Longer-term rates for conservatively underwritten loans now hover in the lower 4% range. Very low leverage debt may dip below 4%. Given investor demand for purchasing mortgage debt, the best pricing opportunities favor larger deals, for example, $30 million plus. Lenders offer more efficient underwriting and effective loan syndications for larger deals. Interim loan programs, mainly bridge debt, is readily available from banks and mortgage funds, as lenders seek competitive yields by climbing up the risk curve. Furthermore, interest-only, non-amortizing debt remains abundant. All in all, numerous capital sources will aggressively compete for any reasonably viable real estate venture. Since debt is very favorably priced, equity investing remains extremely challenging, with no relief in sight. Yields are squeezed for nearly all asset types and classes. Even so, many buyers starve for core product based on the belief that core plus and value-add investment returns are comparatively low given the additional risk. On the other end of the spectrum, opportunity ventures, particularly new construction, still draw investor attention, but escalating construction costs squeeze yields to paltry levels. Finding favorable returns continues to be the most challenging responsibility of any investment manager. The Real Estate Capital Institute's director, John Oharenko, notes, bargains are few and far between. Realty investing has risen to new heights as a desirable investment class, both institutionally and with private capital.
August 1, 2018 Real Estate Capital Scoreboard - August, 2018. Chicago, Illinois, August 1, 2018. The continued trend of flat rates carries over from late spring. The 10-year Treasury note finally broke the 3% barrier, the first time since the summer of 2011. Such a relatively flat yield curve indicates that a market correction is on the horizon. However, unabated economic growth proves otherwise. Similarly, mortgage spreads are still tight with permanent debt pricing at bargain levels, despite continued threats from the Fed of rising rates. Yet spreads are expected to widen to more closely parallel rising corporate bond yields. Debt capital oversupply assures that various lending sources will continue to tighten spreads, while offering more competitive features as differentiators from the large field of players. Below are various examples of how some lenders approach markets for snagging deals. Got apartments? Agencies are a good bet for both pricing and leverage, funding loans at a record pace. Recent approvals to lend at higher leverage levels should keep the momentum strong for multifamily lending, for example, 10% more leverage using 105% debt service coverage. Best pricing across most property types? Life co-pricing persists within the 150 to 170 bits per second range, and can even dip towards the 100 bps range for very conservative loans. This funding group definitely is the price leader, as long as proceeds are not the main consideration. Need loans of 70% LTV or more, and looking for a retail property lender? Conduit pricing starts in excess of 200 bits per second for higher leverage, with about 50 bits per second premiums for even more dollars. Also, greater comfort with retail properties as this sector shows signs of recovery from better integration of bricks and mortar stores with internet marketing. Want lots of flexibility? Debt funds provide dollars with very creative terms, but at a price. Creatively structured loans are offered in the 300 to 400 bits per second range. Such funds are focusing more on mezz debt, seeking aggressive risk-adjusted returns. Mr. John Oharenko, director of the Real Estate Capital Institute, suggests, mortgages still are priced very favorably at about 5% or less for most types of deals. He adds, conservatively leveraged deals will be offered in the lower to mid 4% range.
September 3, 2018 Real Estate Capital Scoreboard - September, 2018. Chicago, Illinois, September 3, 2018. With inflation progressing slightly above the 2% mark and the domestic economy showing uninterrupted growth, the Fed is expected to raise rates one or two more times by year-end. That said, benchmark 10-year treasuries are stubbornly low, at levels consistent with late spring/early summer. Mortgage spreads are also flat, translating to interest rates typically in the lower 4% range for floating rate loans, and approximately 4.5% to 5% for fixed rate debt. With mortgage rates predicted to reach higher levels combined with ongoing new construction supply, buyers take a cautionary wait-and-see attitude towards select multifamily, lodging and industrial deals. The retail property sector still is bargain hunters' turf, while office deals remain selectively targeted. As a rule, infill deals of various property types are in highest demand, while value pricing typifies suburban assets. As investors get a better grip on supply/demand dynamics and interest rates, pricing uncertainty prevails. As such, fresh acquisition financing activity is limited, and refinancing and takeout loans represent the bulk of debt volume. John Oharenko, director of the Real Estate Capital Institutes, suggests, as summer ends, expect more pricing discovery for both debt and equity deals. More attractive pricing may be on the horizon for patient investors.
October 1, 2018 Real Estate Capital Scoreboard October 2018. Chicago, Illinois, October 1, 2018. As highly anticipated, the Fed unanimously voted to raise rates by a quarter point last month, the third increase this year. The increase is part of 8 consecutive rate hikes in just over 3 years. No rate hike relief in sight due to a buoyant economy backed by a low unemployment rate staying below 4%, with no serious signs of slowing down along with tame inflation. A 9th rate hike is possible before year-end. And as many as 3 to 4 rate hikes are expected over the next couple of years. With fixed-rate debt at the forefront, popular funding programs offered by major lending groups are outlined as follows. Agency green programs will continue expanding, as such debt represents about a quarter of their lending volume. Mezzanine programs gain significant interest, particularly for workforce housing, with as much as 10% additional leverage available. Overall pricing starts in the 150 bps range over treasuries. As expected, floating rate fundings are down, but still popular for value creation situations with pricing starting at 190 bits per second over LIBOR. Conduits, active in the higher leverage lending arena with pricing starting at 200 bits per second over swaps. Higher leverage loans above 75% LTV cost about 50 bits per second. Life companies, mostly satiated, as annual funding goals on target. Staying competitive in the 145 to 165 bits per second range over treasuries on 65% LTV or less. Pricing premiums of 10 to 20 bits per second offered for loans of 15 years or longer. The Real Estate Capital Institute's director, John Oharenko, advises, despite an impending inverted yield curve, a strong indicator of recessions, we are following a clear path of increasing rates based on current Fed policy.
November 1, 2018 Real Estate Capital Scoreboard November 2018. Chicago, Illinois, November 1, 2018. The US dollar dropped from record levels of the past year and a half. Moreover, the most recent domestic job report shows the lowest levels of unemployment in nearly 50 years. Such news helped minimize Treasury volatility during the past month, fluctuating by about 15 basis points. Short-term indices, namely LIBOR, inched upward by only a few basis points. As expected, 10-year Treasuries moved to nearly the same levels as the beginning of October. In the end, benchmark rates behaved predictably, given the Fed's desire to gradually raise rates over the next few quarters. Lenders worry about potential market corrections mainly based on interest rate hikes, oversupply and economic slowdowns. They flock to quality deals via lower spreads and less leverage as the main underwriting defenses. With lower leverage and favorable debt pricing offerings at hand, borrowers focus on raising more cash on deals. For much of this decade, the capital stack trend continues for generating more equity from yield-hungry investors, so raising money is less challenging than finding good investment opportunities. As expected, mortgage rate ranges are priced very tightly due to strong demand for investing in realty capital markets. Shorter-term, fixed-rate debt offerings, for example, 5 years, are priced nearly identical to 10-year debt, encouraging borrowers to take on longer debt mainly via agency, life company, conduit and debt fund sources. 7-year maturities are slightly better priced, about 10 basis points inside of 10-year debt. However, even as short-term debt pricing is less favorable compared to permanent loans, floating-rate bank loans are still popular with borrowers for development and repositioning projects. In these instances, flexibility is more important than pricing. Fixed-rate permanent debt starts at 4.5% for low-leverage life co-offerings, climbing to the 6% range for 80% conduit/debt fund loans. Otherwise, most commonly priced loans are within 4.75% to 5%. Mr. John Oharenko, director of the Real Estate Capital Institutes, states, under very competitive realty funding conditions, creative capital stack solutions are the norm, not the exception. Commercial real estate is no longer a stepchild investment class on Wall Street.
December 1, 2018. Real Estate Capital Scoreboard December 2018. Chicago, Illinois, December 1, 2018. Recent financial market developments resulting from trade wars, global instability and a cooling economy are giving the Fed reasons to back off from an additional rate hike this month. Such favorable interest rate news helps mortgage rates stay in borrower-friendly pricing territory. Proof of low rates is most clearly illustrated by current benchmark 10-year treasuries priced at 30 basis points lower this month compared to November's peak level. This rate almost mirrors April pricing, except for short-term rates, which are now nearly 50 basis points higher. And compared to the sum of the best rates seen this decade, summer of 2016, overall pricing is about 125 basis points higher, still relatively attractive by modern historical standards. As is the trend for quite some time, long-term debt continues to be the most attractive funding option versus short-term loans. While interest rates hold somewhat steady, other notable realty capital market news include: 1. Agencies comfortably hitting their annual multifamily production targets. 2. HUD guidelines for speeding up processing of low-income housing tax credits. 3. Life companies meeting their lower leverage funding goals well before year-end. 4. Banks maintaining strict underwriting discipline on construction lending. And 5. Debt funds moving into the more competitive pricing arena in direct competition with mortgage conduits. Markets remain flooded with surplus capital across all levels of the capital stack, including debt and equity. Yields are compressed and risk-adjusted pricing is in record low territory. Fears of loosening underwriting standards are mitigated with more investor equity than witnessed in previous financial cycles. Lenders carefully compete on pricing instead of higher leverage, as evidenced by converging perm loan underwriting among conduits and debt fund players. The Real Estate Capital Institute's director, John Oharenko, stresses, lenders are already starting to dip into their 2019 funding allocations, especially life companies. Some lenders avoid quoting new deals until their 2019 budgets are soon finalized.